Welcome everyone to this webinar. What happens to share prices in the US and Australia if inflation stays high or goes higher? My name is Dr. Sam Wylie. This is the 5th webinar in a series of webinars for private investors like you on how to respond to the COVID-19 crisis. So just a little bit about me before we go on. I am a Principal Fellow at the Melbourne Business School in the Finance Group, where I've been since 2004. I'm also the founder and principal of a consulting and education business called Windlestone Education. So before coming to Melbourne Business School in 2004 with my wife Tracy, we were in the States for 7 years. I was a junior professor at Dartmouth University in the finance group there. Before that, I was a PhD student at the London Business School at the University of London. And before that, I did a bunch of different things. Haven't always been an economist and an academic. Now, there's a set of slides for this presentation that we're going to work through here. If you don't have the slides and you want them, you can email me at Melbourne Business School or even better at Windlestone. And then we will send you a copy of the slides. Now, as I said, this is the 5th in a series of webinars. The first webinar in September 2020 asked the question, how should investors respond to the COVID-19 crisis? And the answer was to stay invested, because no matter how bad the epidemic got, there would be a wall of cash coming out of central banks that would keep asset prices, including share prices, high. Then we moved on to looking at residential property and housing prices in Australia and what was going to happen to them as a result of the record low interest rates being held low for an extended period. And we looked at the RBA's prediction that the housing prices would rise between 20 and 30% and why that prediction made sense. And it turned out that their prediction was correct. Housing prices are up 27% since that prediction was made. Then we moved on to look at what would happen if inflation comes back strongly to the stock market in the US and in Australia. And we were able to work through a prediction for how much the stock market would go down if the unwinding of quantitative easing was forced onto the Fed. And we're going to continue that. It's really a continuation of that webinar that we have tonight. Then we looked at negative real interest rates and the effect that negative real interest rates has on investors and why negative real interest rates turn investors who were lenders into borrowers, why negative real interest rates cause rational investors to use more debt in their investing. And by negative real interest rates, what I mean is actual interest rates, nominal interest rates with inflation taken out. So at the moment, the cash rate in Australia, the RBA's cash rate, 0.1%, minus inflation of 3.5% in Australia, then at the short end of interest rates, a negative real interest rate of 0.1 minus 3.5 minus 3.4%, historically low levels. In the US, it's minus 7.5% at the moment. And this will endure or become even more negative. And it's a very important issue for investors in thinking about how much leverage, how much borrowing to bring to their investing. Now, tonight, we are in an extension of webinar 3, and we're going to look at whether early and large quantitative tightening is going to be forced onto the Fed by rising inflation and the effect that that will have on US share prices. So let's just jump back to where we were in webinar 3 in April 2021. And where we got to was that a massive volume of quantitative easing had caused US share prices to go to historically high levels. And then everyone was expecting in April of 2021, the Fed, the bond markets, everyone was expecting that inflation would rise under the influence of the huge amounts of stimulus from government spending and creation of new money and low interest rates over the following 12 months. Well, we're 10 months into that. And inflation's gone up hugely. In the US, it's gone up to 7.5%, more than almost anyone expected. And the question back here in April was, if inflation goes up, then what happens after that? Will inflation continue to rise or stay high? Or will it fall back? Will it fall away? Will it spike and then fall away? Because where we got to in that webinar was that if inflation stays high, then the Fed will be forced to end, first of all, taper and slowly, but then end quantitative easing, the creation of new money. And then it might be forced to have an early and large unwinding of quantitative easing. Unwinding of quantitative easing, otherwise known as quantitative tightening, otherwise known as balance sheet normalization, otherwise known as the shrinking of the Fed's balance sheet. All of those things are the same thing. Everything in finance has to have 3 or 4 names for the same thing. Nobody knows why, but it's simply a fact. Now, where we got to here was that if the Fed is forced into, by high inflation, inflation staying higher, going even higher after spiking, then the Fed would be, if the Fed was forced into early and large unwinding of quantitative easing, then that would cause the US stock market into a very major correction. And how we came to the 30 or 40% figure here, that's really the subject of the third webinar. I'm not going to go back to that right now, but we are going to continue with this, continue with our discussion and look at what's happened since then. Of course, the Fed and the bond markets think that we will be on this path. Even though inflation has gone incredibly high to 7.5%, the Fed and the bond markets think that it will fall away. And that because it does fall away, the Fed will be forced to raise interest rates, but it won't be forced into early and large unwinding of quantitative easing, early and large quantitative tightening. And of course, if inflation falls enough, then we'll never have unwinding of quantitative easing. In the previous cycle in the GFC, only a very small amount of the huge amount of quantitative easing during the GFC was ever unwound, as we're going to see tonight. And if inflation fell even more than that, if we went back to the very powerful deflationary forces that existed in the world before COVID-19 came along, and I'll remind you of what those powerful deflationary forces that push inflation down, were like before COVID-19 came along. If we go back to that, not only will there not be an unwinding of quantitative easing, we should expect that there'll be more quantitative easing. Eventually, there'll be more quantitative easing. If all of the influence of COVID-19 passes and we get back into the long-term picture of powerful, powerful long-term deflationary forces in the world. So we're going to continue with this. Now, I should just point out that, come back here, I haven't described here, if you're coming to these webinars for the first time, I haven't described what we mean by quantitative easing, and I certainly haven't described why quantitative easing causes stocks to go up. Well, I'm going to revise that tonight and go deeper on it, show you more data and go deeper on the effect of quantitative easing. So it'll work for people who are new to this webinar and also for those of you who were able to see previous webinars. So here's where we were in April of 2021. Now here's where we are in February 2022, really at this incredible juncture, this turning point. We don't know whether we're going up here or down here. The Fed and the bond markets think we're heading down here. Before Christmas in early December, and talking to clients and discussing and writing about this, I had this, and now of course we're just talking about Sam's subjective opinion, but I had this as 70% and this as 30%. Now, after the inflation data in the US for November, December, and January inflation, which have been incredibly high, I have this as 50% and this is 50%, even 45, 55. The last 3 months have really moved, in my opinion, the probability that we are on this path rather than this path up significantly. And hence, that's why we're having this webinar, to continue our discussion of what happens if we are on this path. Now, because we're talking about inflation, let's have a look at some inflation data. And we're looking at the Consumer Price Index in the US, going all the way back to the end of the Second World War, 2 years after the end of the Second World War. And what we can see is that inflation, after it spikes, typically falls away. So you can see why the central bank, the Fed and the bond markets think that inflation might spike and fall away, because that's historically what's happened in the past. But I would point out that we don't really have historical context, because in none of these previous episodes of inflation spiking and then falling away was there a massive Fed balance sheet. In none of these previous episodes had there been a vast amount of quantitative easing by the Fed. So we're really in new territory here without historical precedent. Now we're going to talk about share prices as well. So let's have a look at the S&P 500 in the US. We can see that from the bottom of COVID-19 in March of 2020 to the peak of the S&P 500, it rose by 215% from here to here. A massive surge under the influence of quantitative easing, as I'll show you again tonight. A massive surge in the S&P 500 over the last 2 years, and really over a very long period of time under the influence of quantitative easing. So the S&P 500, by historical measures of value, is overvalued by quite a lot. If we measure the total value of shares in the S&P 500 in the US stock market to GDP, to the size of the economy. It's never been as high as it is now, at over 250%. If we look at price to earnings ratios, and especially the cyclically adjusted price to earnings ratio, the CAPE ratio, cyclically adjusted price to earnings ratio, Shiller's CAPE ratio, that's at historically high levels. If we look at the yield on the whole market, the amount of cash that's coming out of the market relative to the total value of the market at historically low levels. So by historical levels, the market is overvalued, considerably overvalued. That's not true of the Australian stock market. So we'll look at the ASX 300, and what we'll see is that the ASX 300 is not overvalued by historical measures. And we'll talk about this more in another webinar, but quantitative easing has had its expression, as we had predicted in previous webinars, in Australia in the property market rather than in the stock market. So the US market heavily overvalued by historical measures, and the Australian market not overvalued by historical measures. Now, what can the Fed do about the sudden spike in inflation and the possibility that inflation continues at high levels or rises? Well, it's got to tighten monetary policy, which means tapering and then ending quantitative easing. So that's going to happen by March. And in Australia, that's happening in this month. Quantitative easing comes to an end in February. Then the Fed, of course, can raise interest rates, and the Fed is expected to start raising interest rates at its March meeting, and then the market is expecting a 25 basis point, 0.25% increase in interest rates in the US from the Fed in every one of the Fed's 7 remaining meetings. And the Fed itself will see the Fed's predictions itself of increases in interest rates. We'll see the Fed is predicting 4 or 5 increases in interest rates this year. Everyone's expecting that. But the big question is quantitative tightening. Will there be an early and large unwinding of quantitative easing? This is really the elephant in the room. This is the thing that we have to have this webinar about. This is the thing that we need to understand. And that's really what this webinar is about. Let me tell you what the main points are going to be before we go on. So quantitative tightening by the Fed during 2022 is now more likely to occur sooner than most market participants think. Shrinking of the Fed's balance sheet will have a powerful downward force on shares. 30 to 40% is the correction we can expect if there's an early and large quantitative tightening program forced on the Fed by rising or just inflation remaining high. The effect on emerging markets would be even greater. We'll talk about that in another webinar. The ASX 300 would be dragged down with the S&P 500, which would be a major buying opportunity. Now, what does that mean for investors, and particularly this idea that the ASX 300 would be dragged down? Well, what it means is that quantitative tightening, the possibility of quantitative tightening being forced on the Fed and a major correction in US stocks should be factored into tactical asset allocation for investors who do tactical asset allocation. And for other investors, private investors like you and me, we should see a large fall in the US market, a big correction if it comes about because of quantitative tightening, as a buying opportunity for Australian shares. So let me elaborate on those things, what I mean by tactical asset allocation and what I mean by the buying opportunity in Australian shares. So strategic asset allocation, tactical asset allocation. So strategic asset allocation means over the long term, well, let's start off with asset allocation. So asset allocation means deciding how much of your investments to put in each asset class. You know, what percentage of your investable wealth to put into Australian shares, into global shares, especially US shares, into fixed income, meaning bonds, into commercial or residential property, into private asset classes like infrastructure, private equity, private credit, real assets like farms and forestry and the like, etc. All of those things, Aussie shares, global shares, bonds, real estate, private assets, all of those are asset classes. And asset allocation is deciding how much of your wealth to put into those asset classes. And strategic asset allocation is looking forward into the long-term future and thinking about how much you're going to have invested in those different asset classes going forward over the long investment journey that you're on, and only slowly changing it as long-term factors change. Now, what will feed into your strategic asset allocation? Well, number one, how much risk do you want to take? So you're going to be in risky asset classes if you're to the right on the risk spectrum, and it makes sense for you to take a lot of risk, and you're going to be in low-risk asset classes like cash and bonds, as opposed to high-risk asset classes like shares and property, if you are on the left-hand side of the risk spectrum. If your personal characteristics put you on the left-hand side of the risk spectrum. What else is going to decide your strategic asset allocation, your long-term asset allocation, which will only change very slowly? Well, it'll also depend upon your view on what will happen, on which of those asset classes are going to do the best. If you think that investing in US shares is really important because the US economy is such a juggernaut, and especially such a powerful tech force, then you're going to put more money into US shares, into international shares, and especially into US shares. If you're very bullish about commercial real estate, then you're going to go more into that. So your level of risk, and then your view on the different asset classes, and then perhaps some aspects of what type of investor you are, whether you're a personal investor or whether you're a professional money manager. That's strategic asset allocation. That's what private investors like you and me do. Now, tactical asset allocation is a much more short-term thing. It's not thinking 3, 5, 10, 30 years. It's thinking 1 month, 3 months, 6 months. And how are we going to change our allocations short-term? You know, we're not thinking about very long-term trends in the global economy. We're not thinking about decarbonisation and urbanisation and the aging of populations and the influence of tech and the like. We're not thinking about those things. We're thinking about short-term things like increases in interest rates and an unwinding of quantitative easing, etc. So not long-term megatrends, but short-term influences on the market. Ordinarily, private investors like you and me shouldn't really undertake tactical asset allocation, shouldn't try and time the market. Trying to time the market is a great way to spend too much time in cash. If you go out of the market and you stay in cash for ages, and that adds up over time. You spend too much time in cash, you don't earn high enough returns, don't take enough risk. And it's also a great way to incur transaction costs of buying and then selling shares or other asset classes. So ordinarily, we shouldn't do that. Private investors shouldn't do that. That's really something for professional investment teams at Aussie Super or the Future Fund or Host Plus or the like, for professional investment teams. And that's what I'm referring to when I say putting the possibility that the Fed's forced into quantitative tightening into tactical asset allocation. Something that's more important for private investors like us is the possibility that if there's a big correction in US shares, and it's fairly sudden, it will drag down the Aussie market. And it'll drag down the Aussie market from its current fair value into very good buying territory. So it's just something for private investors like us to factor in, that you may want to go to the upper bound of your investments in Aussie shares. If the US market goes down, it might be an opportunity to re-enter the US market. If for some reason you're a bit underweight compared to your strategic asset allocation. If the Aussie market gets dragged down into good buying territory, then you might want to go overweight in your strategic asset allocation and then let that overweighting fall away over time. As new money flows into your investments, put it somewhere else to get back to the right balancing for Aussie shares. But in any case, tactical asset allocation for professional teams, thinking about the Aussie market being dragged down if there's a big correction in the US for private investors. Now, how I want to take this forward is we want to think about what's going to happen with quantitative tightening in the current cycle. So we've already had a cycle in the global financial crisis of loosening of monetary policy and then tightening of monetary policy. And a large period of time between those two. Cutting of interest rates and quantitative easing, and then tightening of monetary policy. And now we are in COVID-19, but we've seen a whole cycle in the GFC. And now we're in COVID-19, where we've had loosening of monetary policy at the beginning of COVID-19, the cutting of interest rates and massive amount of quantitative easing. And now we're into the tightening phase. We're only halfway into the tightening phase, and we haven't gotten to the quantitative tightening part. We want to look at what happened through the full cycle of the GFC to tell us what we should expect to happen in COVID-19. Like this. In the GFC, the cutting of interest rates and then quantitative easing and the loosening of monetary policy And then several years later, the tapering of quantitative easing, the winding back of quantitative easing and ending of quantitative easing, the raising of interest rates, and then some quantitative tightening. What we'll see is that quantitative tightening was abandoned in the GFC. And we'll get to that in just a bit. But loosening and then tightening in a complete cycle. Now we're in the COVID-19, where at the beginning of the crisis, we had the cutting of interest rates to zero in February of 2020, and then a massive amount of quantitative easing in both the US and in Australia. So that's easing of monetary policy. And now we've had tapering of QE in the US and Australia, ends in March, in February in Australia. The raising of interest rates, which won't start in Australia for a long time, but are expected to start in the US in March, and for there to be a large number of interest rate increases. So we're through to here, but what about quantitative tightening? What about the unwinding of quantitative easing? What should we expect, looking at the previous cycle, to happen in this cycle? That's what we want to understand. Now, those of you who've been to my previous webinars, you knew I was going to flash up this slide because I show it in every webinar, because it's so much the backdrop to all of these discussions, that there's only really been one cycle in long-term interest rates since the Second World War. They went up until the early 1980s, and then it's been down, down, down since then. Now, there's been business cycles, but there's something beyond the business cycles. There's something secular going on down here, something beyond cycles. That's what secular means in economics. Beyond cycles going on here. And what's embodied in these long-term government bond yields is inflationary expectations. Down, 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 under powerful, powerful deflationary forces in the global economy, where those deflationary forces are the aging of populations, new technology that has a deflationary effect, globalization, and the concentration of wealth. Those four things, powerful, powerful deflationary forces forcing inflation down. Now, we don't know what happens next. We do know that inflation has jumped up. This, of course, is showing inflationary expectations rather than actual inflation. But we don't know what happens next with inflationary expectations and then actual inflation, whether this is a turning point or whether after COVID-19 we simply go back to the world of powerful deflationary forces and we're fighting deflation rather than fighting inflation. So we don't know what happens next. And of course, there's many things that could happen between those two possibilities. But this is the very important backdrop. Okay, now GDP growth, let's just compare what happened in the GFC to what's happened in COVID-19. You can see that there was a massive drop into negative territory in global growth, both in the GFC and in COVID-19. You can also see that everything's more compressed in COVID-19. It's deeper and steeper, and that downward spike and the surge upwards over a shorter period of time. Deeper and steeper here. And in the GFC, growth was really ticking along very nicely globally, 5% before the GFC. After the GFC, growth never got back to where it was. It was around 3% after that. And so growth has been tepid since the GFC. And because of that, there wasn't a surge in inflation. In fact, there was the fighting of inflation, the fighting of deflation through this period of time. It's very different to here, where we've had this surging growth, vast amount of stimulus, government spending and creation of new money, and a big surge in inflation, surging growth and surge in inflation in COVID-19. Now here we're looking at US inflation. A minute ago I was showing you the CPI figures, which are these blue ones, but I also wanted to show you the personal consumption expenditure measure of inflation that the Fed uses. And this is the PCE, with the volatile components of food and energy taken out. And you can see how stable this is over time. No wonder the Fed wants to use it as its measure of inflation, but it's surged upwards. And this graph doesn't even have the January figures in it, which are expected to be 5.5%. You can see there's a real break with the past here in inflation. And this has a lot of momentum. Now, the Fed and the bond markets think this is going to fall away. We'll see. Let's hope that happens, but we'll see whether that does happen. Now, inflation through the GFC, in the GFC, inflation actually went negative. It went into actual deflation, falling prices. In the US, in Europe, especially in Japan, that hasn't happened in this crisis. Such was the amount of stimulus, even though it was a worse economic hit, economically a worse crisis, COVID-19, than the global financial crisis. There was so much stimulus that inflation never went negative in the United States, and now it's surged up into very high territory. CPI, 7.5%. That's a very big number. What about our favourite country? Well, here in Australia, we have 3.5% inflation at the moment, significantly lower inflation for a set of reasons we can talk about later, one of which is the inertia in wage setting in Australia, because so many wages are set centrally and set under enterprise bargaining agreements in Australia. There's a certain amount of inertia in wages that there isn't in Australia, which has helped to slow down inflation. It's really wages that the RBA is fixed on. This slide needs some updating. We don't have the last quarter 2021 in here yet, and it'll be up here. But the RBA, the governor of the RBA, Philip Lowe, has said repeatedly he needs wage growth to be above 3% permanently before he raises the cash rate. Of course, the cash rate is the benchmark for mortgage rates, which is so important in Australia. But he needs this to be permanently, not to spike and drop away, but to be permanently above 3% before he's raising the cash rate. And that's why his statement that he's not raising the cash rate until 2023, that's his expectation, I think is really quite credible, regardless of what people say in the press. Now, what we're going to do here is we're going to look at the history of interest rate changes in the GFC and then in COVID-19. And then we're going to look at the history of quantitative easing in the GFC and COVID-19. Now, you might think, well, Sam, why don't you just jump straight to COVID? Why don't you just jump straight to quantitative easing and forget about interest rates? Well, they're very closely connected. And we won't be able to understand what's happening with quantitative tightening unless we see the history of interest rate changes. They're both the tightening, increasing interest rates and tapering and then unwinding quantitative easing. Those two things are so closely connected in the tightening of monetary policy that we need to look at them both. So interest rates first. So here we are, looking at interest rates set by the Fed. That's the US analog of the RBA setting the cash rate in Australia. And what we can see here is that in the lead up to the global financial crisis, which starts in July of 2007, the Fed is raising interest rates to try and control a big booming property market in the US. Now, it turns out that boom in property markets leads to subprime securitization, which creates a big problem in the banking system. And here we have the beginning of this global financial crisis in July of 2007. And that ticks along. And it turns from a financial crisis in the banking system into a global economic crisis when one of the global investment banks, Lehman Brothers, collapses in September of 2008. And this is really where the GFC becomes the major economic crisis that it is, or that it was. And at that point, the Fed, which had already been cutting interest rates, cut them immediately to zero, essentially, and kept them at zero, between 0 and 2.5%, but let's just call that zero. They have a target range of 0 to 25 basis points, but let's just call that zero. They kept them there for 7 years. Now let's contrast that with COVID-19. In COVID-19, which we'll come to in just a second, the Fed cut interest rates again to zero, and now it's looking just 2 years later. So in February, in 2020, it cut it to zero. And in March of 2022, it will start to raise interest rates. Everything's much more compressed in COVID-19 than in the GFC. The 7 years here is 2 years here. We'll see how important that is for understanding quantitative tightening. Now, just moving along here. So no increase in interest rates for 7 years. And then we get down to here. Janet Yellen is now the governor of the Fed. And Janet Yellen undertakes 9 increases in the interest rates fairly slowly over a long period of time, and is projecting 3 more increases into 2019. But events turn against her. Global growth slows, but especially inflationary expectations start to fall, and powerful deflationary forces assert themselves. And to fight inflationary expectations falling, the Fed has to start cutting interest rates again. It does that here, and of course, COVID-19 comes along and it's forced to cut interest rates simply to zero. What we should take away from this is that the Fed wasn't able to get to very high interest rates, but interest rates were being cut before COVID-19 came along. The first person who died from COVID-19, as far as we know, was on the 9th of January 2020 in Wuhan. But interest rates were being cut before that because of powerful deflationary forces. And that's what we go back to if COVID-19 simply passes. If the effect of COVID-19 passes and we get back to those very long-term deflationary forces, that may be what we're going back to. Okay, what I want to look at now, before we go on to talking about quantitative easing, is the Fed's expectations about increases in interest rates. So the Federal Reserve Board, unlike the RBA in Australia, the Federal Reserve Board, which has 18 members, the Federal Open Market Committee, which is a part of the Fed that sets interest rates and approves quantitative easing, it has 18 members. At the end of every second meeting of the Fed, and there's 8 meetings every year, so 4 times a year, those members at the end of the Fed meeting are polled, they're asked about their expectations about interest rates going forward. Now you might say, well, the Fed's going to set interest rates, so why don't they just tell us what they're going to do? Well, they don't know what they're going to do. They're going to base what they do upon data that hasn't been realized yet, that's in the future. But they're just telling us what they're expecting they're going to do with interest rates going forward, which is a very helpful thing. It's a pity that our RBA doesn't do the same thing. And these are called the dot plots. And what they show is 18 dots for the members of the Open Market Committee saying, and this was in September of 2021, saying, each member saying what they think interest rates will be, the Fed funds rate will be at the end of 2022, and at the end of 2023, and at the end of 2024. And then 2 months later, 3 months later, at the end of December, in the December meeting, I should say, the Fed doing the same thing, the members of the Open Market Committee doing the same thing. And what we can see here is how much their expectations about interest rates have moved up. So just over these 3 months, and since December, they will have moved up significantly again. And we won't find out until the March meeting what the dot plots look like, but they'll be significantly higher because of the data about inflation. But you can see here, most of them were expecting that in September that there would be no increase in interest rates in 2022, that interest rates would still be at 0 by the end of 2022. No one's expecting that now. And then by the end of 2023, most of them, or half of them, were thinking that interest rates would be below 1%. The Fed funds rate would be below 1%. None of them thought it would be below 1% by the time we got to December. Interest rate expectations by the Fed have really moved up. The Fed's been surprised by how strong inflation's been. It still thinks that inflation falls away from here and that early and large unwinding of quantitative easing won't be necessary or desirable. And the bond market agrees, but we'll see. The probability that inflation stays higher, goes higher, has really significantly increased. Let's look at what happened to the analogue of the Fed funds rate in Australia, the cash rate over this time. Well, we didn't really have a GFC in Australia. Interest rates were cut when the GFC came along because of the hit to global confidence. But then we had mining boom 2.0, mining boom 1.0, mining boom 2.0. Right at the moment, we're in mining boom 3.0. Despite that, interest rates are not going up. So inflationary pressure is definitely going to build up in Australia. But again, let me remind you that interest rates were being cut before COVID-19 was even known about. Interest rates were cut to record low levels in Australia by the RBA on the 1st of October 2019. And it's not because there was a lack of growth. The RBA was predicting 2.5% growth in 2020 and 2.75% growth in 2021 when it cut interest rates, despite strong growth. And it's because inflationary expectations were falling off a cliff. The powerful deflationary forces in the world. This is what we go back to. People don't pay enough attention to this. If inflation falls away significantly from here, if all the stimulus in the COVID-19 crisis is not enduring and doesn't cause any long-term increase in inflationary expectations, then that's the world that we go back to, fighting deflation. We need to be careful what we wish for here. Okay, now I'm going to talk about, now we are through talking about interest rates. We'll be coming back to that and comparing it to quantitative easing, but now we're going to look at quantitative easing. And this graph is what we're going to be focusing on mostly. It's the Fed's balance sheet. It's the assets on the Federal Reserve Board's balance sheet. So I'll show you what the RBA's balance sheet looks like in just a bit. But this is the Fed's balance sheet. And we're going to look from the GFC right through to the present. And over here, what we have is the Fed's balance sheet rising from 1 trillion before the GFC to nearly 9 trillion now. These are trillions of dollars, millions of dollars. It's a lot of money. And a massive increase, a massive creation of new money. And it's had an incredible effect on share prices. And the unwinding of it will have an incredible downward force on share prices. Now, I want to remind you of what is meant by assets on the Fed's balance sheet in this way. So this is the Fed's balance sheet, what it owns and what it owes. On the right-hand side, what it owns and what it owes to others. On the left-hand side, assets and liabilities. As we said, 9 trillion here, 9 trillion here. Let's start with the liabilities. Money in circulation, greenbacks in circulation, in the purses and wallets of individuals and in bank vaults. The actual folding currency, 2.3 trillion approximately. And then here, the deposits of banks at their bank, the central bank. So in the US, the deposits of JP Morgan and Citigroup and Bank of America and other banks deposited into the central bank, into the Fed. In Australia, this would be the deposits of ANZ and National Australia Bank and Westpac and CBA, and plus all of the credit unions and building societies and foreign banks and regional banks deposited into the RBA. Now, those two things, with just a small amount of other stuff, are matched by the assets of the central bank. And there's some other stuff. So there's foreign currency, there's gold, and a few other things, but mostly it's bonds. Mostly it's bonds purchased in quantitative easing. Quantitative easing causes this to go up and it causes that to go up in a way that I'm going to remind you of and take you deeper in the explanation of as we go forward. So when we say the assets of the Fed and the increase in the assets of the Fed, we're talking about the buying of bonds, buying of treasury bonds, government bonds, and also agency bonds, bonds issued by the big housing agencies in the US, Fannie Mae and Freddie Mac. Okay, so back to this. Now we can see that we've had 4 stages of quantitative easing, of expansion of the Fed's balance sheet by the buying of bonds. 3 in the global financial crisis and 1 massive one in the COVID-19. We've also had a period of quantitative tightening where the Fed was allowing some of those bonds to mature and not rolling them over, not reinvesting the money that had been paid back to the Fed, because every bond matures eventually, short-term and long-term bonds. And ordinarily, they're just reinvested in new bonds. But here, they're being allowed to mature without being reinvested. And the Fed's balance sheet is shrinking. And we'll talk about that episode in the GFC or at the end of this GFC period in just a moment. Now, let's look at each one of these as we go along. So with the collapse of Lehman Brothers in September of 2008, the Fed didn't really know what to do. It had to experiment. We'd never had quantitative easing before, so it cut interest rates to 0. That wasn't enough to stop the US economy plunging into outright deflation. They were worried that they were going to head into the deflationary abyss that occurred in the Great Depression in the United States when unemployment went to 26%, believe it or not, in the United States. Imagine that now. So to avert that and to fight deflation, they just started to create new money. It's not literally the printing of money, as I'll remind you of just a moment, but it is nonetheless the creation of new money, the creation of deposits. Now, that worked, but eventually it wasn't enough. When we had the Euro sovereign debt crisis, where Greece nearly tumbled out of the Euro, and there was a big hit to global confidence, then inflationary expectations started to plunge again, and they needed another bond buying program that was not nearly enough, as it turned out, and so they decided on a big program. Start buying $40 billion of bonds a month, and then pretty quickly buying $85 billion of bonds a month over an extended period to create a lot of new money to fight deflation. And then eventually the tapering of quantitative easing, the slow ending of quantitative easing here. Now, Ben Bernanke, who was the governor of the Fed at this time, tried to taper quantitative easing, but there was a taper tantrum. There was a big revolt against the tapering of quantitative easing, which he wasn't able to quell. By the time we got to here, Janet Yellen is the governor of the Fed, having replaced Ben Bernanke, and she actually is able to undertake quantitative tightening, quantitative tapering, I should say, the tapering of quantitative easing over this period. So then quantitative easing comes to an end, but the bonds are being reinvested as they mature. And then there's a period of 3 years during which nothing happens, a long period of time. The Fed, I doubt, is going to have that luxury in the current cycle, but let's talk about that in a minute. And then the Fed decided that it might be able to normalize its balance sheet under Janet Yellen and get back to, shrink the balance sheet, get back to normal. So it started a phase of quantitative tightening, letting $10 billion per month of bonds mature without being reinvested, and then 20, then 30, then 40, then 50 billion per month. But eventually there was a revolt against that, as we'll see when I show you what happened with the stock market in this quantitative tightening. Eventually the stock market revolted. It went down 20% before the Fed relented, before the Fed said, okay, we're going to stop quantitative tightening. You can see they didn't get very much done before they were forced by the market to stop it, because the market went down 20%, 19.9%, the S&P 500, as I'll show you in just a moment. But they didn't stop it immediately. They tapered it. The Fed doesn't want to do anything immediately with the markets. The Fed, when it wants to increase interest rates, talks about it for ages and then announces that it'll start increasing interest rates and then does it. When it wants to have a program of quantitative easing or quantitative tightening, it'll talk about it for ages. It's talking about quantitative tightening now. And then it will decide to do it, but it'll start it sometime after it started. And if it introduces it, it'll introduce it slowly. And if it winds it back, it'll wind it back slowly. You know, the Fed treats the markets like it's a wild animal. You know, when you approach a wild animal, you don't want to have any eye contact and you don't want any fast movements. You don't want to spook it. And that's the way that the Fed treats the markets. It doesn't want to do anything quickly. But in this crisis, in COVID-19, everything sped up. And what's speeding it up is just the imperative of fighting inflation. That 7.5% is such a big number that the Fed doesn't have the luxury of doing things quickly. This is what I mean by early and large quantitative easing. The Fed would really like to take its time, but will it have that time? Well, not unless inflation falls away quickly and substantially. Now, notice also that the Fed had only raised interest rates by 1.25% before it started quantitative tightening. Remember that the Fed starts to raise interest rates here at the end of 2015, and it's raising interest rates through this period before it's forced to stop raising interest rates by slowing growth and by the revolt in the market. But it's raising interest rates through here, but it only raises interest rates to 1.25% before it starts quantitative tightening. We can see that if we just go back. If we go back to here, we can see that it starts tightening interest rates at the end of 2016. Now, this is where quantitative tightening starts here at the end of 2017, when interest rates are only 1.25%. What that means for the current cycle is we shouldn't expect the Fed to raise interest rates too much before it really wants to start to do something about the balance sheet as well. Don't think that the Fed has to raise interest rates to 3 or 4% before it wants to do something about the balance sheet. Okay, so quantitative tightening came to an end, and then shortly after that, completely unanticipated by everyone, of course, we had the COVID-19 crisis, in which there's a massive amount of bond buying here, of quantitative easing, $2.8 trillion. Let me expand this part, just this green part, into a bigger slide. I'll do that in just a second. But first of all, note that the tapering of quantitative easing, the same as this, the tapering of quantitative easing has already been undertaken, and more quickly than previously. You know, this is tapering from 85 billion to zero. This is tapering from 120 billion to zero. Everything is speeded up in COVID-19. This 3 years between the ending of QE and the beginning of QT, you know, that there isn't going to be that luxury. If inflation stays high, this is going to be in months, not in years. Now, just expanding on this part, expanding this into a bigger slide, we can see here 2.8 trillion in the space of 3 months. So what took 6 years in the GFC to do $3.5 trillion of bond buying took 3 months in COVID-19. Everything is massively sped up in COVID-19. It's a key difference between the two cycles. The 2.8 trillion, and then 120 billion per month, which is now being tapered, which will be finished in March. Now, what I want to have a look at is the effect of quantitative easing on the share market in the US. So we've got 3 things to look at here. The 3 rounds of quantitative easing in the GFC, and then quantitative tightening in GFC. And then the quantitative easing in COVID-19. We want to use those three things to say something about what we expect to happen with quantitative tightening if early and large quantitative tightening comes in COVID-19. So we're going to look for each of those three things now at the effect of them on the S&P 500. So here we have QE1, QE2, QE3. You would have seen this in a previous webinar if you were able to attend. And what we have here is we're putting the S&P 500 through time on top of the increase in the Fed's balance sheet. It's putting one graph on top of another. It's not really a substitute for econometrics or economic theory, but it's very profound, isn't it? It's very stark, the effect here. How much the increase in the Fed's balance sheet, quantitative easing, in each of these three rounds drove up the S&P 500. So that's the first thing. Now, the next thing is to look at quantitative tightening. So what we have in the blue part here, this blue part here, this blue section here, is this blue section here. That might resolve as grey on your computer, but this section of quantitative tightening is expanded down here, this period. We have quantitative tightening taking place. And notice that during this period, from the end of 2015 through to here, we have raising interest rates, 9 increases in interest rates through this period. And the increases in interest rates don't tank the market. Increasing the Fed funds rate doesn't drive the S&P 500 down. The S&P 500 goes up 50% as interest rates are going up. And because the share prices aren't driven by short-term interest rates. They're driven by long-term interest rates, the yields on 10-year government bonds. But the effect of quantitative tightening is quite profound. The market falls 20%, not straight away, because quantitative tightening is pretty modest to begin with, 10 billion a month. But once it gets cranked up to 50 billion a month, there's a revolt in the market. And the market goes down 20% before the Fed relents. And then the Fed doesn't end quantitative tightening straight away, it tapers quantitative tightening. But nonetheless, with the tapering of quantitative tightening, the market goes back up to higher than it was before it went down. You know, this is the reverse of quantitative easing. We're seeing that quantitative tightening, the genie going back into the bottle, is having the reverse effect of the genie coming out of the bottle. Now, here, we are looking at the $2.8 trillion expansion. This is this, expanded a bit more. So over this period of 3 months, $2.8 trillion of bond buying. So when the COVID-19 comes along, the S&P 500 falls off a cliff once it becomes clear just how bad the epidemic is. The Fed begins its incredibly large bond buying program of $2.8 trillion of bonds in 3 months. It arrests the fall and unwinds it, reverses it, arrests the fall in the S&P 500. And it's not like the fundamental economic conditions of the global economy are getting better here. The global economy is falling into the abyss because people can't go outside of their houses. But nonetheless, the power of money coming out of the central bank arrests the fall and sends it back up again. And so we have the three things here. We have QE, QE1, QE2, QE3, driving up the S&P 500. We have quantitative tightening in driving down the S&P 500 in the GFC, at the end of the GFC cycle, by 20%, and the Fed being forced to end that. And then we have quantitative easing in COVID-19 driving up. So you can see that the effect that quantitative easing, quantitative tightening has, that the Fed's balance sheet has on the level of the stock market is really quite profound. In Australia, it's had more of an effect on the housing market for reasons that we talked about previously, and we'll talk about more in the next webinar, which will be us going back to talk about the housing market going forward in the crisis. Now let's just stop to have a brief advertisement for my Finance Education for Investors course, which is coming up, starting on the 8th of March and running for 10 Tuesday evenings. So these are live Zoom classes in which the limited number of participants can ask questions and we can talk through the issues. They run for 2 hours. If you can't make the classes, then they are delivered video on demand as well. You can watch them afterwards. You can attend the live class and then re-watch the video on demand version of it. As well as there being videos of the classes, there's supplementary videos because we can't cover all the topics in 10 lots of 2 hours. There are 540 PowerPoint slides, and there's one-on-one discussions with me, which people find extremely useful. The purpose of the course is empowerment and getting to better outcomes, really giving you the feeling that all of the important topics in investing are clear to you, that you have a very clear investment process to work through. We take you through a 10-step program of working out of self-evaluation by you. I give you all the knowledge and all of the structured opportunity to work out what's right and what's wrong about your investing, and we work through that in a 10-step program and fix up what isn't right about your investing. So it's very empowering in those ways, and we develop an investment philosophy as well. And it's not just about empowerment, it's getting to better outcomes, more wealth, faster growth in your wealth as time goes on. So it's coming up. Maybe you know someone who's taken it. I'm confident if you ask them, they will say that they had a terrific experience and it's made a huge difference. You can see a full explanation of the course here. If you go to here to see the information session, you can go to windlestone.com and enroll in the course. It's $1,200 plus GST. And the enrollment is on a per household basis. So everyone in the household who live together in the household can undertake the course together for the $1,200 plus GST. Okay, back to our program here. And now I'm going to talk more about the Fed's balance sheet and about how quantitative easing has an effect on, or why quantitative easing has such an effect on asset prices. And I talked about this in previous webinars, but I'm going to go deeper here, you'll see. Now, remember what we were saying just a moment ago about the assets and the liabilities of the central bank. And I've stacked these up differently. It doesn't matter how I stack them up. I had reserves on top previously. Just all that matters is that this side equals that side. You'll see why I stack them up like this. Quantitative easing expands bonds and expands bank reserves in the following way. Let's just remind ourselves to understand what extraordinary monetary policy, like quantitative easing is. We'll start off with normal monetary policy. In normal monetary policy, the cutting and raising of interest rates, the cutting of interest rates to speed up the real economy, more consumption by households, more investment by firms, more exports and less imports as interest rates affect the exchange rate. The speeding up of the real economy is undertaken by cutting interest rates, but the central bank doesn't act on the real economy. It only ever acts, normally, on the banking system. When the banking system stands between the central bank and the real economy, the central bank puts money, that's what's called monetary policy, into the banking system to cut interest rates, increases the supply of liquidity to reduce the cost of liquidity, the price of liquidity, interest rates, and that reappears as lending to support consumption, the buying and building of houses and of cars and holidays and the like, and investment by firms. So this usually works beautifully. The increase in the supply of money decreases the price of money, and this reappears with a big multiplier down here in Australia. Every dollar that goes in here reappears as $15 of lending to households and to firms. And ordinarily that works beautifully. Cut interest rates, it stimulates demand down here and simultaneously provides the credit to support that extra consumption and investment. It's a beautiful system. But it hasn't been enough to fight deflationary forces. So we have had extraordinary monetary policy, very unhealthy and unusual. And if you went back 20 years, you wouldn't think that this was even possible. Advent of quantitative easing, extraordinary monetary policy. Now, in quantitative easing, the central bank bypasses the banking system and households and acts directly on institutional investors, the big investors, the big super funds, big pension funds, the big insurance companies. In Australia, this is the Aussie Supers and Future Funds and Hosts Plus and AMPs and colonial first states of the world. And globally, and especially in the US, this is PIMCO and BlackRock and Fidelity and Vanguard and American Century. They have trillions and trillions of dollars, hundreds of trillions of dollars between them globally. The Fed acts on them by buying bonds. The Fed writes checks to buy bonds, and then the bonds go back into the Fed. Now you might say, where does the Fed get the money to write checks? Well, it just creates the money out of thin air. How does the Fed create new currency when it wants to expand the amount of currency? Well, in the US, they just take sheets of cotton and print them up into greenbacks. In Australia, The RBA just orders the mint to take sheets of plastic and print them up into pineapples or redbacks or whatever you call Australian currency. You know, the central bank has a monopoly over the creation of money. It can create money out of out of thin air, and that's what's happening. It's writing checks on itself. And let's say that it's PIMCO down here, the massive institutional investor in the US. PIMCO sells $100 million of bonds. And remember that ultimately this is $8 trillion of bonds over the GFC and COVID-19. But just in this one instance, PIMCO sells $100 million of bonds to the Fed in exchange for a check. What does PIMCO do with the check? And why did they sell the bonds? Because the Fed offered them a high price. They'll sell anything if the price is high enough. But now they've got a check instead of their bonds. What do you do with the check? You deposit it in your bank. So they put it into JP Morgan, or let's say they put it into Citibank. What does Citibank do with the check after PIMCO's deposit is created? Well, Citibank deposits it in their bank, and that creates the bank reserves, the deposits of banks with the bank's bank, the central bank. And so we've got bonds increased by 100 million, bank reserves increased by 100 million. Now we'll see the influence of this on housing prices in Australia. I'll come to that before we end this webinar. Now, all of this wouldn't really amount to anything very interesting in terms of inflation if it wasn't for these deposits. It's the creation of these new deposits that's the issue for inflation, because PIMCO doesn't want to hold on to those deposits. It doesn't want deposits. I mean, you think about the US at the moment. In the US, deposit rates are 0 and inflation is 7.5%. Your real deposit rate after the effect of inflation is minus 7.5%. Who wants that? Well, someone's got to hold the deposits, but PIMCO doesn't want the deposits. PIMCO is going to use the deposits to buy some assets. It's going to buy some more bonds in the market. Government bonds, corporate bonds. It's going to replace the bonds it sold here by buying some bonds in the market. Whoever it buys the bonds from has now got the deposit. And they might buy some shares from someone else. Whoever they buy the shares from has now got the deposit. And they might buy some property from somebody else. And now whoever they buy it from has got the deposit. And what has to happen is for someone to be happy to hold the deposit and to earn the minus 7.5% real interest rate at the moment, then it has to be that asset prices are so high that they'd rather hold this deposit with the minus 7.5% real interest rate than buy overvalued assets. That's what has to happen. Somebody has to hold the deposit, and the deposits get passed around as investors buy assets from each other until someone says, you know what, I'd rather hold cash in the bank than hold S&P 500 shares at 4,800. Or I'd rather hold cash in the bank than hold commercial property that's yielding 4.5%. Asset prices have to go up until people are prepared to hold those deposits. And when you pump more money into the system with more buying of bonds and more creation of deposits, asset prices have to come up even more. This pumps asset prices up. And that's how it works. Now, I present it as though that's the only thing that can happen to deposits. And that's not right, of course. We're leaving out the deposits could be used for consumption. So the deposits could be used to buy a car. It could be used to go on holidays. It could be used to go to the movies. It could be used to buy a pair of jeans. It could be used to buy a book, etc. So it could be used for consumption. And of course, that's what the Fed wants. That's what central banks want. That's what quantitative easing is for, to create consumer price inflation, not asset price inflation. We're trying to fight deflation here. We're creating this new money in the form of deposits to try to get consumption, extra aggregate demand to drive up consumer price inflation. But of course, what the Fed's mostly got in the GFC is asset price inflation and all the problems that go with that, including just the sheer inequality of this making wealthy investors even wealthier, and the political issues that go with that shouldn't be understated, and most of which haven't been realized yet. But there's something else here, and this is where I want to go deeper than the previous discussions that we've had. There's something different in COVID-19. What's different in COVID-19 from the GFC is that in the GFC, most of these deposits, almost all of them, these new deposits, are held on the balance sheets of firms or institutional investors or wealthy households. Now, these guys, firms and institutional investors, simply aren't allowed to use the deposits for consumption. If you're the CEO of a firm, you can't just take the firm's cash and go out and buy yourself a Mercedes-Benz. You can if it's your firm, but you can't if it's a publicly listed company. And of course, the same with institutional investors and households who are very wealthy, which is where most of these deposits end up in the GFC, just don't have a very high propensity to consume. They spend a lot more of their money on investing and saving than households with low incomes. Well, in COVID-19, a lot of these new deposits are with households who have low incomes and who have a high propensity to spend. Now, look at this graph. So this graph is showing US demand deposits. So these are deposits you can access immediately. You can go to the bank and go to the ATM and take the cash out in folding cash. You can write a check, which they do a lot of in the US. You can use your debit card. You can access the money immediately because it's in a demand deposit. Now, there's $18 trillion of deposits in the US. Most of them are either institutional or corporate, or they're household deposits, but they're in term deposits, locked up. These demand deposits are only a fraction of that. But they have absolutely soared in COVID-19. They've gone from 1.6 trillion. You can see that they are households with their salaries and wages flowing in and then being used up, and flowing in and then being used up. You know, these are households with relatively low incomes that have a propensity to spend. Now, it should really show it every fortnight or every month. It's just the infrequency of the data that causes it to be more spread out like that. More the sawtooth pattern not to have a higher frequency. But in any case, this soaring of demand deposits, money ready to spend, money in the accounts of relatively low income households with a high propensity to spend, most of this doesn't come from quantitative easing. It comes from a big stimulus package by President Trump, $900 billion, initiated by the Trump administration and then through the Congress, and then a $1.9 trillion after President Biden comes into office, a $1.9 trillion. So $2.8 trillion of checks sent out to relatively low income households and sitting in their demand deposit accounts, ready to spend. Now, if that money does get spent, and it is being spent and driving up inflation, but if we get what is referred to, if we get a lot of circulation here, if we get what economists call a high velocity of money, where people spend it on going to the movies, and then whoever ends up with the money at the movie theater puts it back into the bank, and then they spend it on buying some jeans, and whoever ends up with it in the selling of the jeans uses it to buy themselves a car, etc. You know, if the money circulates in the economy through consumption with high velocity, inflation will soar. And here's the key point. If inflation soars because of this velocity of money, because of the new deposits, and it doesn't matter that these new deposits came about because of government spending rather than QE, if these deposits circulate rapidly in the economy through consumption and drive up demand and drive up inflation, the only way to end that will be to drain the deposits from the system. And raising interest rates won't get the job done. The Fed will have to drain the deposits by unwinding quantitative easing. If we get a high velocity here, the Fed will have to have early and very large unwinding of quantitative easing to contain inflation, and that will absolutely tank the S&P 500 for the reasons we talked about in the previous webinar. This is a very important point, which is front of mind for analysts and for economists at the moment. Not all of them fully understand it, I should add, but plenty do. No one here has a monopoly on wisdom or information. Now, let's just have some more data on this, okay? So consumer spending is way up in the US. Consumer spending is up 7.9%. So it was last month when this data came out, the highest increase. So these are percentage changes over the previous year. The highest increase over the previous year since the end of the Second World War. You can imagine that at the end of the Second World War, when you have this incredible ending of the building of armaments and beginning of consumption spending, that it's going to be much higher than that. But the highest level, year-on-year increase in consumer spending since the end of the Second World War. Now, you would think that what's driving that consumer spending is very confident and ebullient investors, consumers, I should say. You would think that consumer sentiment must be sky high if they're spending so much money. But actually, consumer sentiment's at a very low level. It was high before COVID-19 came along, or getting back to nice high levels before COVID-19 came along. COVID-19 trashed consumer sentiment, as you might imagine. There was a return to something more normal. But then recently, it's fallen way off in the United States. It's at very low levels. And there's something that doesn't make sense here, or that just don't go together. The highest growth in consumer spending since the Second World War and very low consumer confidence. Those two things just do not go together. You know, what squares those two things is the deposits. Is those deposits burning a hole in the pockets of households that have a high propensity to spend. You know, we've already got consumer spending at 7.9% in the US year on year, and consumer confidence is down. What's that going to be like if consumer confidence goes back to normal levels? And that velocity of spending through consumption, driving up demand and driving up inflation, it's really something to watch out for here. You know, we have much higher consumer growth in personal consumption. You can see that this is real personal growth in personal consumption with inflation taking out. It's usually very stable. Fell off a cliff in COVID-19, recovered, but was still negative. Then we had the stimulus packages way up, but now it's gone to a very high level and is sitting at this high level. Okay, now here I'm just showing you that if it does, I just thought I'd throw this slide in to show that a lot of the bonds held by the Fed, which reflect all of Treasury bonds, they don't try to choose any particular bonds, that a lot of the bonds held by the Fed are relatively short term. If they decide to undertake early and large quantitative tightening, all they'll have to do is let the bonds run off, and it will happen pretty quickly. So where are we up to? Well, here we are in February 2022, and we don't know whether we're heading up here or heading down here, but we do know the probability we're heading up here has gone up significantly in the last 3 months because of the high inflation prints. We do know that the Fed and the bond market still expect that we'll head down here. And we also know that if we do head up here, we can see from the analysis that we've had here in the historical review that we've had here in the webinar, that if the Fed is forced into early and large quantitative tightening, unwinding of quantitative easing, then a very large correction in the S&P 500 is coming. And that correction would drag down the Aussie share market into very good buying territory. People, private investors like you and me, should just sort of think that through. We don't know what's going to happen, but it helps to think things through early. Because when a crisis comes along, it's very hard to act. If the S&P 500 was to fall off the cliff, to quickly go down 25% or 30%, drag the Aussie market down with it, it's very hard to act. You need to think that through. It's not obvious that'll happen. It's like 50-50 or lower that it'll happen. But you need to think about it in advance if you're thinking that might be an opportunity. So here we can see, I thought I put this slide in from Goldman Sachs. This is before the January inflation print, which was quite a shock. But you can see that Goldman Sachs thinks that inflation will fall away, but not very quickly. Not so quickly. It'll still be quite high at the end of 2022. And then come down here, and let me remind you about the S&P 500 and the ASX 300. That, you know, let me just point out to you that over the last 25 years, the S&P 500 has gone up by a factor of 6. And the ASX 300, this is what I mean about the ASX 300 not being historically overvalued, has gone up by a factor of 2.3. Now, we should expect more growth up here than down here because yields are higher here than here. Australian shares have higher yields because of dividend imputation. That is because of franking credits. If you don't know what dividend imputation, also known as franking credits, is and how it affects portfolios, well, take my investments course. I'll show you comprehensively how they work with different parts of portfolios, including family trusts, and why it's really important to know how dividend imputation works. But in any case, we should expect more growth up here than down here, but not that much more growth. I mean, there's strong reasons to believe that this is significantly historically overvalued, and this is not. But if this falls quickly, it'll drag this down, and it'll drag it down into very good buying territory. Now, let me wind up here by saying something about the RBA and housing prices in Australia. This is really just a teaser for the next webinar. I want to show you what the RBA's balance sheet looks like. So here we're looking at assets, here we're looking at liabilities. So with the RBA, what we have is both the buying of bonds, quantitative easing, and also the lending of money to banks. This is the term funding facility, where the RBA lent $188 billion at almost zero interest rate for 3 years to banks. This is what the Europeans do. This is really the European version, the European Central Bank's version of the Fed's quantitative easing. The European Central Bank lends a lot more money to banks rather than buying of bonds. It does some of both, but it's especially down here. And the RBA has chosen to do both. It's got like a hybrid model of the American model of balance sheet expansion and the European model of balance sheet expansion. Why it chose to do both is something of a mystery. But it has the same effect in the sense that that expansion of the RBA's balance sheet expresses itself over here as an increase in the deposits of banks at the RBA. So you see, the banks always have some deposits at the RBA, but not much, just a few $1 billion. Next thing you know, it's $450 billion. This expansion in the RBA's balance sheet expresses itself as these reserve deposits, which are called exchange settlement accounts, of the big banks and the credit unions and building societies and foreign banks and regional banks at the RBA. Now, this burns a hole in their pocket. They don't get any interest on this. The interest payments on this is zero. So the banks in Australia got $450 billion of deposits that they didn't have before at the RBA that they get zero interest on. They would love to take the money out, which they can do anytime they want, and lend it out as a juicy mortgage. To take this asset, to take the money at the RBA and lend it out and get 2.5% or more as a juicy mortgage. They'd love to do that. So they're fighting for mortgage share. And that fighting for share in the mortgage market will keep a lid on mortgage rates. A really powerful battle going forward between the banks to get mortgage share and drive down their margins. Now, of course, if the RBA raises the cash rate, mortgage rates will go up with it. But we should note the one thing that will help to prevent the RBA or will dissuade the RBA from doing that is that if the RBA was to raise, let's say the RBA was to raise the cash rate by 2%, then it would have to pay 2% here. And 450 billion times 2% is 9 billion a year. And that would be money out. And it wouldn't be matched by money in because this is all fixed and wouldn't change with the cash rate. And so you'd have $9 billion more of money out if the cash rate went to 2%. And the RBA just doesn't have that much capital. That's the red line down here. They would have to go to the government, the federal government, cap in hand, and ask for a capital injection if they were to raise the cash rate to 2%. Now, that doesn't mean they won't do it. They will do it if they have to. But it is just one thing to bear in mind. The more important thing to bear in mind is that the competition between banks to keep mortgages rates low here. Okay, we're going to talk about mortgages more when we get to the next webinar. Now, what have we not talked about? We haven't talked about the Main Street versus Wall Street issue, the big political issue. Raising interest rates is bad for the ordinary Americans. Quantitative tightening is bad for Wall Street and for wealthy Americans. So there's going to be a big political tension here. We haven't really talked about that another time. Why hasn't the market already fallen off a cliff if the danger of quantitative tightening is material? Well, let's talk about that as well next time. What's the role of negative real interest rates? Why will emerging markets be hit even harder? The effect on the US dollar. How does QT translate into the RBA and Australian property prices? Well, in the next webinar, we're going here. Other webinars will go into these questions. There's only so much we can do in one webinar. Don't forget about my Finance Education for Investors course coming up on March the 8th. Maybe you know someone who's taken it, ask them about it. They'll tell you how good it is. I'm very confident of that. If you want to ask me anything about it, then just send me an email at Melbourne Business School or at Whittlestone, as you can see from the slides at the beginning. Thanks for coming to the webinar, and I'll see you at the next one.